Hello, and welcome to the launch of the International Energy Agency's new Oil 2024 Medium-Term Market Report. I'm Jethro Mullen, head of the IEA's communications team, and I'm joined today by IEA Executive Director, Dr. Fatih Birol, and by Toril Basoni, the head of our Oil Industry and Markets Division, who led the analysis for the new report, which, I note, is free to read and download on our website. So during today's press webinar, Dr. Birol will make some opening remarks, and then Toril will present the key findings of the report. We'll then take questions from journalists. For the journalists taking part in this press webinar, we invite you to send your questions via the Q&A function in the Zoom. You can do this at any point during the presentation, and we'll also take a 2-minute break right after the presentation for you to enter your questions. And with that, I'll hand over to our Executive Director, Dr. Birol.
Many thanks, Jethro. Greetings to all the colleagues who are following this meeting from the International Energy Agency headquarters. Dear colleagues, many of you know that we look all the fuels, all the technologies, oil, gas, renewables, nuclear, electric cars, and everything, and we make a lot of reports, statements, and share data with the international community. And today we are going to talk about oil, because we, as you know, every month we publish our oil market report, which is a benchmark report for the oil industry, looks at oil demand, supply, trade, refinery, and other issues. But in addition to that, again today we are releasing our report for a medium-term outlook for the oil markets for the next 5 years, and provide some vital insights how the demand supply can develop, implications for refinery, trade, and the different players in the markets. So I would like to, as our colleague Jethro Mullen mentioned, I would like to offer some thoughts in the beginning, and my colleague Mrs. Basoni, who is the head of our oil market division, will share some of the key findings. So let me start from demand, the oil demand. This year's report does confirm our expectations that we have outlined last year. So in that respect, it is good to see that what we said last year is happening this year. One of them is our expectation for the oil demand growth 2024. Already mid last year, June 2023, we said we would expect global oil demand growth 2024 will be around 1 million barrels per day. And depending on the changes in the policies, economic prospect, this number went a bit higher, a bit lower. But here, my colleagues, Mrs. Basoni and her colleagues, came up with a similar number. Our expectation of global oil demand growth this year is about 1 million barrels per day. And I'm happy to see that the other, or I should say most of the other commentators and the institutions' expectations are more or less in line with our expectation here. And we do expect that looking at the beyond 2024, oil demand growth will continue to slow down, and before 2030 will plateau and then sees a peak. So what are the drivers of this global oil demand growth slowdown? There are many important drivers, and they have been explained and discussed in depth in our an excellent report, Oil 2024. The colleagues who are interested in those details may look at it. But when I look at the report, what are the key drivers of the slowdown of the global oil demand growth? I see three major drivers. The first one is on the transportation sector. The major penetration, strong penetration of the electric cars in China, in Europe, US, and more in the emerging countries is a key driver. In one of our recent reports, we said that this year we expect more than 1 out of 5 cars in the world sold will be an electric car, and the other indications we are getting from the market is confirming this number, maybe even slightly higher. And more important than that, that sales number, we also see that China, which is the driver of the electric car penetration around the world, because every second car sold in the world, electric cars in China today, we see that the electric cars are becoming cost competitive vis-a-vis their counterpartners in terms of the internal combustion engine cars. So this is transportation sector, plus of course the ongoing efficiency improvements in the transportation sector is another driver. So this is number one driver of our expectation of the global oil demand growth slowdown. The second driver comes from the electricity generation. Today, especially in the Middle East and some North African countries, we see significant amount of oil is used to generate electricity. It's about close to 1.5 million barrels per day, driven by mainly in Saudi Arabia, Iraq, Kuwait, and the others. And we know that in many of those countries, especially led by Saudi Arabia, there are strong plans in place to replace the oil used for electricity generation by renewables or natural gas. So this is another important driver. Third, and in my view, perhaps the most important driver here for the slowdown of the global oil demand growth comes from China. Dear colleagues, nobody, I would say nobody, who wants to understand what is happening in the energy markets can afford not to see the change of economic growth prospects in China. When it comes to oil markets, in the last 10 years, about 60% of global oil demand growth came from China alone. And at that time, Chinese economic growth in the last 10 years increased on average slightly higher than 6% per year. And now we assume, and many international institutions, Chinese institutions, everybody expects a slowdown of the Chinese economic growth. This would mean that our expectation, many international institutions' expectations, Chinese growth will slow down economic growth to about 4%. So this will have implications, of course, for the Chinese energy demand in general and oil demand in particular. So putting these three drivers together, what is happening in the transportation sector? What is happening, a specific case, but an important case in terms of the substitution of oil in electricity generation in Middle East and North African countries. And third, China, the largest oil importer of the world, Chinese economy slowdown results in our expectation of the slowing down of oil demand growth following the rebound coming from COVID. And of course, there are sectors which are still pushing the demand up, such as two of them are important in my view. One of them is aviation, with the jet fuel, strong growth coming from jet fuel, and the booming petrochemical sector. These are two important drivers of oil demand in the next years to come. In terms of countries, Asia, as usual, is the main driver. India emerges as a growing demand center there. When it comes to advanced economies, North America, Europe, Japan, and others, the declining trend continues, and our expectation is the oil demand levels for the advanced economies in 2030 will be coming to the level that the advanced economies saw in the 1990s, early 1990s. So, dear colleagues, this is the view on demand, but maybe I should give you a general claimer that this is those numbers that I have tried to highlight to you are based on the current existing policies that the governments have today. And of course, if the government's policies change substantially this or that way, they may have an implication for this demand trajectory. A few words on the supply side. We are seeing a strong growth of supply coming from Americas, basically, so-called non-OPEC countries. Who are they? United States, Canada, Brazil, Guyana. We did look, Mrs. Bosani and her team look project by project around the world, but also in the Americas, and the numbers we are seeing, the growth coming from the non-OPEC supply, especially from Americas, are higher than the global oil demand growth we expect. And this would have implications, of course, for all of us, all the producers and consumers around the world. And one of the implications, with the current policies in place, is current rather high oil spare production capacity, about 6 million barrels per day, will continue to increase, and towards the 2030s will reach around 8 million barrels per day. A major surplus, and in my view, if I am not wrong, it might be one of the highest in the history we are expecting. Of course, if such a development happens, it will have implications on the prices, on the markets, and all the producers will be affected, including those in the United States, the shale producers. So to sum up, dear colleagues, I can tell you that we are going to see some important changes in the oil markets, but of course these are based on the policies that the governments have today. If the policies change in this or that direction, they may have an impact on our numbers, calibration here, higher here, lower there. Or if there were major geopolitical crises, this could have an implication on the oil markets, as we all know, or some major changes on the global economic prospects. Recession here, economic boom there, may have implications on our numbers. But currently, with current policies in place, current economic growth and market expectation, this is the picture we have, and it is, in our view, important for the all producers and also consumers to see these developments, demand, supply, and the resulting implications, to see whether or not their business strategies are in line with these, I would say, new realities of the oil markets. So before passing the floor to my colleague, Mrs. Bosoni, I wanted to say that the IEA, we will continue to look at the data, number analysis. I always say data always wins. So we will look at the data, but not only for oil, for gas, solar, wind, nuclear power, electric cars, investments, and we will try to inform the international community, policymakers, industry, as much as we can. So now I would like to turn to my colleague, Mrs. Boston, with my thanks. Totally great work to you and to your team for looking at both the demand, supply, refining, and trade in such detail, and looking forward to hear from you.
Thank you, Dr. Birol. And good morning, ladies and gentlemen. I'm very happy to be here today to present this outlook to 2030 that was prepared by my excellent colleagues in the Oil Industry and Markets Division, but also with input from many experts across the agency and beyond. So while the oil market is dynamic and fast evolving as it's ever been, a few key developments that we have highlighted for some time now remain. And one of those is that we're seeing oil demand, the pace of oil demand growth slowing significantly over the forecast period and going into a small contractions by the end of this forecast period, when we see oil demand peaking at around 105.5 million barrels a day, including biofuels. So based on the current policies and behaviors, we do see oil demand 3.2 million barrels a day higher at the end of the forecast period, however, so continued growth, but a slowing pace of growth over the period. And just a word on the very near term, we also released our monthly oil market report this morning, where we downgraded again our forecast for 2024. It's less than 1 million barrels a day, and this is something, as Dr. Birol said in his introduction, that we have highlighted for some time, where we're seeing the real data coming in showing a contraction in global oil demand in March, where non-OPEC, non-OECD growth failed to offset a very large contractions in OECD countries. So in terms of growth countries, as we heard, it's Asia that will dominate growth. Here you can see on the top chart, China, India, and other emerging and developing Asian countries contributing about 1.3, 1.4 million barrels a day of growth each. Over this period, the growth in China and India will, while similar in magnitude, will be very different, both in terms of the evolution over the forecast period and in terms of the product that drives that growth. For China, we're seeing very strong growth in the near term, in this year, next year, and as we move forward, and the growth predominantly coming from the petrochemical sector. India will overtake as the largest single source of growth towards the end of the decade, and in contrast to many other countries around the world, it's the transport sector that will drive growth also in other Asia. And as you can see, we're in the OECD as a whole, we have declines over the period of about 2.9 million barrels a day in total. In terms of products, we heard it's the petrochemical sector and aviation that will drive growth. Here, LPG, ethane, and naphtha contributes the majority of the growth, when you can see that we expect gasoline to be the product that sees the biggest declines, driven by the increase in electric vehicles, but also in fuel efficiency and internal combustion engines over this period. So mirroring the demands break with long-term trends, we're seeing a front-loaded capacity build-out, the supply capacity build-out, slowing over the forecast period. We're going from growth of more than 2 million barrels a day in 2023 to about 1.8 this year, next year, in global oil supply capacity, into a small contraction by 2030, based on the projects that are firmly committed at this date. The growth is dominated by non-OPEC plus countries here in blue. They account for 4.6 million barrels a day, or 76% of the net increase. And United States, 2.1 million barrels a day. Other producers in the Americas, including Canada, Guyana, Brazil, and Argentina, adding another 2.7 million barrels a day over this period. As the projects that are sanctions, that are in the sanction queue, fizzle out over the period, you could see production in the US taper off, and you can see Brazil and Guyana going into decline in the absence if no other projects are sanctioned, as those offshore fields deplete rather rapidly. However, should companies swiftly approve projects that are on the drawing board, that are well advanced, we could see another 1.3 million barrels a day of supply towards the end of the project, the forecast period. As for OPEC, we see oil production capacity growth, including condensate and NGL, of about 1.4 million barrels a day. That's led by Saudi Arabia, Iraq, and the UAE. In a major shift in strategy, Saudi Arabia has put on hold its capacity increase, crude capacity increase, that were to take crude oil production capacity from 12 to 13 million barrels a day, and instead are focusing their investments on developing the massive Jafurah field, gas field, that will add about 1 million barrels a day of gas liquids and condensates. So with the growth from the Middle East producers and with continued growth also from the US, natural gas liquids would account for about 45% of the overall supply increase in this period. So with the ramp up in world oil production capacity expected to outstrip demand to 2030, as we've heard, a surplus supply capacity may reach unprecedented levels of more than 8 million barrels a day towards the end of the decade. Total supply increases by 6 million barrels a day to 114. That is, as I said, well above the requirement that we see for oil in this period. And such a supply cushion could append current OPEC plus market management strategy aimed at supporting prices. For now, we note that the alliance have outlined plans for unwinding those cuts, but given the caveat that the unwinding of cuts may be subject to market conditions, we await to include those in our forecast until such a decision is confirmed. And if we move into a lower price environment, this would of course have implications for US shale, normally the fastest respondent to price signals in the market. But how the industry will adjust to the new supply landscape will have wide-ranging implications for producers and consumers globally through the decade. So now moving over to refining quickly, we're seeing a continued increase in refinery capacity over the period, about 5 million barrels a day of new capacity being constructed and completed from 2023 to 2030, but also about 2 million barrels a day of capacity that has already been announced closed, for a net increase of 3.2 million barrels a day. So at the face of it, the additional refinery capacity tracks very nicely with the expected growth in oil demand, but because of the growth in gas liquid supply over this period, and also from biofuels with increases by about 600,000 barrels a day, we see that this non-refined products, or these products that bypass the refinery, will take up 75% of the total demand growth. So we're looking into lower utilization rate for refiners, or potentially increase pressure on some of those capacity to shut. The capacity growth remains concentrated in Asia, most significantly in China and India, but from 2026 onwards, we're seeing that the pace of expansion is slowing also in these key markets. So lastly, looking into see what all this means for trade. As you know, global oil trades were already appended by Russia's invasion of Ukraine and the embargoes on Russian crude that were implemented in following that invasion. So now about 5 million barrels a day of Russian crude oil, plus the majority of the products, 2.5 million barrels a day of oil products, is heading to Asia instead of their traditional markets in Europe. But here on this graph, you can see that the Asia's net import requirements for crude will continue to increase over the period, and with relatively stable supplies from the Middle East and already absorbing all of the Russian crude oils, we're seeing that it is the Atlantic Basin producers that will fill this gap. That will be producers in the United States, Brazil, Guyana, Canada, with a new pipeline tying up Burton production into the Pacific coast. So this is a trend that we expect to see extending into the medium-term period. And the last words before closing up, in product trades, we see very much a similar picture. Increased demand for refined product from Asian countries will increase the import requirements from them, and we're seeing additional supplies from Middle East, where a number of new refineries have recently started up or are about to start up to meet that growing demand in Asian countries, but also increased product exports from the United States. Europe's continued shortfall in diesel and jet fuel, plus North America's shortfall in jet fuel, will focus global competition in the middle distillate markets. So with that, I'll end my presentation today, and we await the questions. Thank you very much.
Thank you very much for the presentation. So we now have time to take some questions from journalists. We invite the journalists in attendance to send your questions through the Q&A function of the Zoom if you haven't done so already. And please mention your media outlet along with your question. We'll take a 2-minute break to give you a chance to enter your questions, and we'll be right back. Hello and welcome back. Thanks a lot for bearing with us. We've got a lot of questions. We're going to try and get through as many of them as possible in the time we have. So we have one from Noah Browning from Reuters, who asks about the forecast for oil demand through to 2030, notably the peak plateau at around 2029. Can we say that this is the first time the IEA has pinpointed such a specific time for this phenomenon? Does it represent any kind of revising forward of peak oil demand? And is there a distinction between peak and plateau? We also have a question from Malcolm Moore on demand, Malcolm Moore from the Financial Times. What is your view of the more bullish demand forecasts of OPEC and others? And specifically a question on 2024. You said your forecast for global oil demand in 2024 is now around 1 million barrels a day. Can you elaborate on that? How does that compare to the forecast of OPEC and others who follow the market? So we have those questions. Perhaps I can put to Dr. Birol, and I think we had one more on from Grant Smith from Bloomberg. Will the pressure to keep such vast amounts of oil offline as spare capacity push OPEC Plus to abandon market management and shift to producing at maximum levels? I will perhaps pass to Dr. Birol to take the questions around demand, and then Toril for the question on supply.
Okay. Thanks for the questions. What we see, again, I want to underline, under current policies, current economic assumptions we have, which is more or less in line with everybody else, and the current technological developments we see, global oil demand slows down, growth slows down, and just before 2030, it reaches a plateau and then peaks. So, first of all, I should say that there is not a big difference between plateau and peak. And even it is a peak, if it stays around the current levels, it is 103 million barrels per day or 104 million barrels per day. There is no much difference for the oil markets, for producers, consumers, or climate change implications. The important thing is what happens after that. Our reports, recent reports such as the World Energy Outlook expects into central scenario that we see a gradual decline from 2030s, and again this is not a big steep decline with the current policies in place. So this is the plateau and the peak, and the difference between 2024 OPEC and IEA numbers. I'm happy that you asked this question. We do respect all the institutions' forecasts, their views, insights, and how they interpret these results. But there's a big but here. Since last June, we said the global oil demand expected to increase about 1 million barrels per day. Sometimes a few hundreds higher, sometimes a few hundreds lower, and almost all other market commentators came around this number. And our OPEC colleagues, again, whom we respect as other institutions, they say this year global oil demand growth will increase 2.2, I guess, 2.2 million barrels per day. So we are in the middle of the year, June. Already 6 months are passed and we only 6 months left. So I think I find this a big difference. One, maybe a bit slightly more than one, slightly less than one, vis-a-vis 2.2. The colleagues who, like us, who make their hands dirty with data every day would understand it. In the middle of the year, such a big gap is something noteworthy. Of course, we will see at the end of the year what the numbers will be, global oil demand growth numbers. But I just thought it is important to see that there is still such a big gap, because our hope, the wider we look at the data every month, every day, to inform, to give the best information for the decision makers, for the public to understand. And this gap is between our numbers and the numbers of our colleagues in Vienna are significantly different. And therefore, I just wanted to bring this perhaps once again to the attention of the colleagues as a response to the colleagues from FT and other institutions.
Thank you. And now I think, Toril, a question on the implications of this very high spare capacity that you're forecasting for the second half of the decade.
Thank you, Jethro, and thanks for that question. Indeed, but we're seeing already today that spare capacity is really high. We have more than 6 million barrels a day of spare capacity in the market today, after OPEC Plus alliance have cut production in a number of rounds over the past few years. Most of the spare capacity is held in Saudi Arabia, the UAE, Iraq, other Middle Eastern countries. But the OPEC Plus alliance, while they laid out a plan to unwind some of those voluntary cuts, extra voluntary cuts from the fourth quarter this year, they caveated that the production increase would only be enacted, or it could be paused or reversed depending on market conditions. So our base case is that those cuts, that capacity will be put to the market only when market conditions warrant. So that's how we see the spare capacity continue to increase. Of course, should producers choose to put more oil in the market than the market absorbs, inventories will build and prices may react, then of course that would have implications for other producers, and most notably those in the United States, which are more price responsive. We're also seeing, just the last word, we are seeing some of the producers adjusting their investment plan. Saudi Arabia putting on hold its crude capacity expansions in favor of gas liquids and gas, which is more in line with where we see demand growth coming in this coming decade. Thank you.
Thanks, Toril. I think we have time for just a couple more questions. We've had quite a lot, so we'll try to cover a few different areas. One from Jonathan Leake from the Daily Telegraph in London, talking about the storyline in refineries. What are the implications for older refineries of the kind found in Europe? If the surplus refinery capacity materializes, would you expect many closures? And then a question from Norway, from DN Norway, Terry Erikstad, who's talking again about this high spare capacity towards the end of the forecast period. How will this projected oversupply of oil be eliminated? So perhaps the refineries question to Toril, and then the the oversupply question to Dr. Birol.
Yes, thank you. So we're already seeing quite a few announcements of refinery closures that are planned in Europe, also United States over the coming years. But it is the reason with oil demand projected to decline by almost 3 million barrels a day in the OECD and the advanced economies from now to 2030. It is the regions that will be most pressured by the increased competitions. We also wait for Nigeria's large Lekki refinery to open up. This has been an outlet for European refiners to sell fuels. Also a refinery in Mexico that is starting up that may put some strain on the US Gulf Coast refineries. So we are looking, we do see the risk for increased refinery closures. There's obviously an opportunity for some of these plants to be converted to biofuel refineries or to have into co-processing with biofuels to meet the clean fuel standards, especially for aviation fuels. That is a challenge that we need to face and deal with for the remainder of this decade. Thank you.
And my question was?
It's the implications of how will the oversupply of oil be eliminated if markets are facing this?
So, dear colleagues, it's not the first time that the oil markets would see an oversupply here, but one important outcome would be downward pressure on the prices. So this will be something important to note, both for the oil producers, companies, but also, of course, for the consumers. For the oil producers, I think it is, in my view, looking at this demand and supply trends, the companies may want to give a fresh look at their business strategies and plans, that they are in line with the market realities. This includes from their new developments, investment strategies, and others, because as we see it, the slowing down of the oil demand growth and the significant increase of spare production capacity, as my colleague Mrs. Toril-Bosseni showed you, could have significant implications, substantial implications for the oil companies. It is time for many companies, producers, in my view, to look at their business plans and strategies, how to deal with this demand and supply trends.
Thank you very much. That's all we have time for, I'm afraid. I think we've covered the large majority of the questions, but if any journalists have questions that didn't get answered during the Q&A that you'd like to follow up on, we invite you to reach out to our press office and we'll get back to you as soon as we can. So thank you very much to Dr. Birol, to Toril, thank you to the journalists for the great questions, and thank you to everyone following this event online for your interest in our work. The full Oil 2024 report is available for free on our website, so do please take a look if you haven't already. And that's all for today. Thank you and goodbye.